Ghana's move to refinance debt at the Eurobond market is witnessing a setback as investors rethink their position over the possibility of a hike in rates by the U.S. Federal Reserve. The dollar bond slipped 10% in 10 days amid rising government debt. Omotola Abimbola, Senior Portfolio Manager at Chapel Hill Denham, joins us to help put this all in perspective. Omotola, thank you for taking the time out to join us today. Quite interesting what's happening at with Ghana's dollar bond. We're seeing it, the sovereign spread now above 1,000 points, the highest since April 2020. Help us put this all in perspective.
Thank you very much, Esther. Thanks for having me. As you mentioned, the Eurobond curve in Ghana has been under severe pressure, but that pressure did not start this year. It actually started towards the end of 2021. And to put the numbers in perspective, currently, year to date alone, over the past 2 weeks alone, we have seen the sovereign yield curve for Ghana's outstanding Eurobond obligation. We have seen the curve move up by over 200 basis points or 2% on a year-to-date basis. And currently, we are seeing the curve average about 12.8%, which is essentially in distressed territory, given the spread compared to U.S. Treasury rates. Now, what's initially, sparked off the pressures that we saw in the Ghana curve since Q4 2021, it was the move by the U.S. Fed to begin to, tighten monetary policy. And for Ghana historically is very vulnerable to any changes in external financing conditions, given the fact that the country operates a structural current account deficit, and it has a very large, or let me say, quite significant external debt obligations. The country's current outstanding debt is over $60 billion, and about half of that is external debt, which is among the highest that we have in Africa. So anytime we are seeing any major changes in external financing conditions, we typically see, Ghana's financial system come under severe pressure, including its Eurobond obligation. But I think one thing that probably, made the market even a bit more suspicious this time around is the fact that, the country's external debt has been growing aggressively over the past 2 years alone. In 2019, Ghana's debt to GDP ratio was about 65%. As of end of last year, that number has gone up to 85% of GDP, which is among the highest that we have in frontier Africa. Also, the fiscal deficit numbers have been very, very poor, particularly since the onset of COVID-19. We have seen fiscal deficits, move up from about 5% of GDP pre-COVID, to over 10% of GDP over the past 2 years. And it's even forecast to only slightly decline, to about 8% of GDP in 2022. So this is a story of a tightening of external financing conditions and a very, very vulnerable, fiscal account, which has put Ghana in the eye of the storm.
Okay, Omotola, if I could just ask you this now, it doesn't appear that Ghana would or could default this year. I mean, it does have robust external reserves for now, but do you see the country being able to roll over that debt in the medium to long term at the market?
Well, the market appears to be pricing in a default currently, because if you look at the yield curve for Ghana's sovereign Eurobond, it has an inflation, which implies that short-term obligations have a higher yield compared to longer-term obligations. And that's a very bad situation to be in, because defaults more often than not will become a self-fulfilling prophecy. So if you are having very elevated external borrowing costs, that would imply that you've been locked, at least in the interim, out of the external borrowing markets. Meanwhile, the country has a very high current account deficit to finance, which it needs external obligations to supply. The same country also has a very high cost of servicing its external debt obligations. Now, reserves are very strong currently, above $10 billion as of the last reporting date in November, but it's also dropping as well on a monthly basis because of the needed, because the BOG has had to intervene significantly in the currency market, where we are seeing a sharp depreciation pressures to at least stabilize the currency. So it's a very bad situation to be in. But I do believe that the country still has some wiggle room to at least avoid a very painful restructuring in the short term. And that's partly because the country has no major commercial debt obligation coming due in the short term.
But if I could just come in here, Omotola, sorry about that, but would it not require the fiscal authorities to quickly begin to consolidate spending and, embark on much needed, perhaps painful fiscal reforms?
Absolutely, I agree with you. Because the next Eurobond obligation of the country is in 2025, which is just about 3 years away. Now, you could argue that the country can continue to pay, at least the debt service cost for this for its $13 billion outstanding Eurobond, at least for the next 3 or 4 years. But then, what would need to happen very, very quickly is for the government to begin to implement some very painful structural reforms, particularly on the fiscal end, to rebalance its fiscal account. The first thing the markets will need from Ghana is to become a much more responsible borrower. We have seen the government, coming to the Eurobond market almost every year over the past 3 years, to borrow money, between $3 to $4 billion annually. That needs to change. The country needs to restructure its debt such that it has less of external borrowing and more of domestic borrowing, where it has a lot more control. So that needs to happen. The market also needs to see, a much more, stronger revenue reform to lift, government revenue to GDP ratio from the current level of 15% to perhaps 20-25% over the short term, so that they can have, enough room to service obligations and also pay, for capital expenditure and pay its recurring expenses. One of the options in front of the government at the moment is perhaps, going back to the high-level for a new program. So if you recall, 2 years ago, Ghana ended its ECF, its extended credit facility program with the IMF. And when the program ended, it came with so much applause because within the 4 years that the program was running, Ghana managed to stabilize its finances. They brought fiscal deficits below 5% of GDP. Debt to GDP ratio stabilized at about 65% of GDP. Inflation rates moderated to single digits. So the program was very, very successful. But what we have seen over the past 2 years since the program ended is that
Omotola, I do apologize that I have to butt in here. I have to butt in here, but thank you so much for helping us better understand this Ghana's bond story. Thank you so much, Omotola Abimbola, Senior Portfolio Manager at Chapel Hill Denham.